So today's Cardinal Lesson, we're comparing a traditional long-term care insurance policy to the hybrid life long-term care policies. And we have specific examples, specific rates, and we just want to get across the comparison of these two large categories. We want to educate you on the facts here. So Tom?
Yeah, I mean, I want to go over sort of two stories, and I could go all day with stories here. But long-term care is important to plan for. So let me give you some examples. I have two clients I'm dealing with right now, like this week that I've met with. One of them is she retired a couple years ago. She was all excited about it, and immediately got thrown into taking care of both her parents. Both were sick, were older, had money, but they were relying on their daughter to come in and take care of them, and it's killing her. Right? I mean, it's just draining her. Every time I see her, it's just worse and worse. And I could go on and on, but it's hard, it's emotional, and it's draining. And it's not, the money piece of it is an important part of it, but it's just the burden put on her is really, really difficult. And so again, that just illustrates the reason why you need to do some planning. Is you don't want to leave your family in that situation, because that ends up who bears the burden of care. It's your kids, it's your loved ones, it's them putting their lives on hold to take care of you because you didn't do the planning when you were able to. And then the other story I have, this is a very sad situation where she's 64. Another example, and it's a client. She's been taking care of her mom for the last couple of years. Now she has a little bit of help, right? Her sisters are trading off. They go and stay with her for about 3 days to stretch at a time. And then all of a sudden, her husband, dies unexpectedly. The client of mine. So now she's dealing with having to deal with the loss of her spouse, trying to figure out the income piece of that, trying to figure out her health insurance while also taking care of her mom. I mean, they're just terrible, terrible situations to see people get into, and it could have been avoided, right? If there was planning done earlier, then the situation would be better than it is now. So again, the insurance, what we're talking about today is long-term care insurance. The insurance alone does not remove all of that, those issues, but it certainly helps a lot. So let me bring up the show notes. You can find these at the link below on our video. They're also on the website at cardinalguide.com. Hans is going to go through some of the numbers on the examples we have with sort of two different types of policies. You can find all the examples in the show notes. So I'm not going to spend right now going through each one because they're all the important numbers are on the board. But if you want to get in there and look at more of the details, those are in the show notes. These were run on 65-year-old male and female are the examples. So if you're younger, be a little bit less expensive. If you're older, a little more expensive. There's some nuance there. So if you're interested in just seeing what it looks like for you, you can call us and we can help run one for you specifically. So let me turn it to Hans, and we'll get into some of the examples we have in the show notes.
Well, thanks for those stories, Tom. Frankly, the numbers and the specifics that I'm going to teach you today, or Tom and I are going to teach you, are not going to motivate you to do something about this problem. I want to tell you that just everybody run with me for a second here. Number one is you might live a long time. That might happen. Much longer than your parents. It's a reality. The second thing is if you do live a long time, you might need care. You might finish your life with somebody having to help you. Okay, and you might be in a position that you're going to need to pay somebody to help you, so you don't wear out your kids and you don't. It's just a whole where people are going to go out of pocket and hire professional help. And the third thing that I want to say is that if you do need care, it's going to be the devastation. It's going to be devastating to your family, not only just you but your family. It throws families into upheaval, and it's just like the stories Tom told you. So what I'd like to do today is I'd like to motivate you to start putting a plan together. And we'd be glad to help you do it. We're licensed in all 50 states and DC, and we represent several more insurance companies than just the two that we're featuring here today. And why we picked the two that we have is we equated the benefits. As you'll notice, the benefits are right here. Both of these policies have very similar benefits. And I'm going to share with those. They're going to start. Both examples are on a 65-year-old male and a 65-year-old female. We've done it on singles just because a lot of times people say, you're always doing stuff for couples. I'm not married. I'm single, so we're going to break it out, a male and a female. And by the way, females pay a lot more for long-term care insurance than males do. They use it more and they use it for longer, so the prices are different. Now, when we take these prices and turn this into a couples policy, either one of them, the overall price comes down 10, 15, 20%, depending on the policy. So there's a big saving is if you buy this as a couple, and that's reflective of couples have a less usage of long-term care. First of all, they're going to take care of each other for perhaps a little longer, and maybe they live a sadder, a safer, whatever the reason are for the numbers, is couples cost the insurance company less than people by themselves. So we're going to look into these shared benefits. So that the example, we've started out at $6,000 a month of benefit payments, okay? And that is going to happen when you're using either home health care, assisted living, or nursing home. This policy, either one of these policies is going to pay exactly the same whether you're getting cared for in your own house, or if you've gone to an assisted living to live, or you've gone to a nursing home. And frankly, not that many people go to nursing homes anymore and stay there for years. I mean, that's more of a short-term skilled situation. So most of the time we're comparing the difference between home health care and assisted living. But either way you shake it, it starts at $6,000 a month. Now, there's little chance if you qualify for one of these policies health-wise that you're going to use it like in the first year. I mean, it's typically something you buy now and then you're going to use later. And so what happens as later comes around is this policy, both policies include a 3% compound inflation factor. So if this 65-year-old, when they get to 85, they've got $10,521 a month of benefits. That's true on both policies. And there's 4 years of benefits, so it's 505,000 is what the benefit maximum has increased to. And then at 95, it's 14,000 a month. So you get the point. This is a pretty robust policy. It has a 4-year limit. You know, you come in to see us, and if you can afford it, we might go longer than 4 years. We might get you out at 6 or 8 years, or possibly even look at a lifetime policy. But this will be sufficient. If I can motivate a number of you to get something like this, it's not only sufficient, it's substantial. Okay? So when we're talking about the benefits, I want to pass it to Tom for a second, and I want him to react to that piece of it, and then we'll get into the specific policies.
Yeah, I mean, I think 6,000 a month is a very meaningful amount of money in today's dollars of what that would cover. Both policies have this inflation component where it increases by 3% a year, compounded. So the benefits you would receive in the future, which is likely when you would actually need to file a claim, will be higher. One of the questions that I will get often is, will this be enough to cover the full cost? And it might not be, right? Depending on the level of care, $6,000 a month might not be enough, but the goal doesn't need to be all or nothing, right? I mean, if you are needing care, presumably you have other money if you're looking at these policies. You can supplement that to an extent. But again, in any scenario, having $6,000 a month means that's not pulling $6,000 out of your income, not pulling $6,000 a month out of your savings. So it's still a very, very meaningful benefit. And again, you can always increase it, right? This is just to give you a starting point, or decrease it, right? The price is relevant to how much benefits you're buying. But I think when you're doing planning, it doesn't need to be ensuring the full risk or none of the risk at all, right? Somewhere in the middle is still very, very meaningful and will be very meaningful to your family as well. So I just want to point that out. But again, like I said, when we're doing financial planning, there's always this give and take, right? Is we have to look at sort of the premium and how affordable is that in the overall plan. And that's why we like building these out as part of a larger plan, making sure that you're able to support that policy, not just now, but also in the future, versus buying something now, getting 10 years later and can't afford it anymore. That would be a bad scenario. So again, that's why we like to build these as part of a larger plan when we're doing financial planning.
Okay, so now to get these benefits, you buy an insurance policy. And so we're looking at a 65-year-old male, $4,528 a year of premium. So we're talking about $375 a month, about short of $400 a month. For a 65-year-old female, $8,067 a year. and you're paying that for the rest of your life. Okay, that's the premium. Now, there is a feature on this side of the equation that if you start using it, it goes into waiver of premium. So, maybe you pay that from 65 to 82, and then you start using it while you're collecting benefits. There's no premiums that are due on the policy. So that is a plus for this side. The traditional long-term care insurance is the least expensive way to get into a policy. So we want to talk about that. And with a number of folks, we start there. Okay. Now, the hybrid life long-term care insurance is different. It's more expensive. And what it's going to do is it's taking a life insurance policy and a long-term care insurance policy, and that's what a hybrid is, and it's putting them together. So on this 65-year-old male, one option for him to get these same benefits would be to put $122,000 into the policy right up front. And he's done paying premiums forever. I mean, it's in force. And when that 65-year-old male passes, he's going to have a death benefit of $144,000 if he hasn't used it for long-term care. So you're putting in 122, you got all these long-term care benefits for your whole life, but if you didn't use them, $144,000 of death benefit is going to go to your heirs. If you did use them and you used them up, I mean, you just went through all the way through the $144,000 of death benefit, and beyond, and you used it for the long-term care, there's still a residual life insurance benefit of almost $29,000. So even if you use, so there's going to be some life insurance benefit in this policy, even if you used it up for long-term care. So, and for the female, that 122 goes to 137,000. So it's more, but it's not as much more as the other side. That's because of the life insurance component. It's same death benefit, same thing. Now, back on the male, he could also, if you didn't want to put up 122 grand, you could pay 15 grand a year for 10 years, and then you're done paying. Or you could pay 10 grand, almost 11 grand a year, where you would pay to age 100. Now, that's a lot of money, and the female is proportionately about the same. It's a lot of money, but there's a key element. Because it's life insurance, these premiums can never increase. These premiums could increase in the future. The insurance company could come to you when you're 75, 80, and they could say, we're losing money on this policy. They have to file it with the insurance department. This could go up. And so that's a big motivator for a lot of people to go over to this side. I'm not going to try, because frankly, if I can motivate you to have a discussion about the problem, perhaps with us, we can do that by Zoom. We can do it on the telephone. We're licensed in all 50 states and DC, and we've chosen these two companies because they're available, not with this exact policy, but close, in all 50 states and DC. But we've got a whole range of policies. So anyhow, if you want to start taking a step toward doing something about this, we'll have a discussion with you, and we'll do that on the phone or Zoom. My purpose, and I want to motivate you to just take some action. So I'm kind of showing you the money here, but I'm thinking just showing you the money and the numbers isn't going to motivate you to do anything about it. Tom?
Yeah, I mean, I think the policy specifics are important, right? That's what you're purchasing when you're buying a policy. So you need to understand that, but that's not what's going to drive the decision to do the planning, right? I mean, typically when we have people coming in proactively wanting to plan or for long-term care, looking at insurance policies, not every time, but most times it's people who've lived with it. They've seen their parents go through it. They've provided care for their parents, and they're coming in and saying, there is no way I want my kids to go through that. So when you boil down all these sort of, people who say, I don't want to do this, I've looked into it, it's too expensive. At the end of the day, that really boils down to the fact they don't think it's going to happen to them, which it might not, right? We don't know. But like Hans mentioned earlier, there is a chance if you live long enough that this could, and if it does, it is going to upend your family's life to deal with it. We just see it every day going through this. I've lived through this, right? I'm young and healthy generally, but I have an autoimmune disease. In this back in 2018, I was in a wheelchair. I was in the hospital for a month in a wheelchair for 3 months following. I mean, you never expect that to happen. Is you don't know when something's going to happen, and once it happens, it's too late to do the planning. I mean, I have another example where we had someone call in this week. He's been watching our videos. Again, another sad situation. He's older. He's in his 80s. He has an MS diagnosis. He's actively receiving care, and he's looking at like, is there anything I can do? And unfortunately, the answer is no. Right? It's too late. There's not any planning that's available for you at this point. Now we can help sort of position the money around how do we pay for it when it comes. So we're not that we just kicked him to the curb. We're still going to help him from a planning perspective, but from an insurance side of things, there's just nothing available to him. So you need to do the planning while you're healthy enough to still qualify for it. And I'll make just one other comment to these people who come in, and we get this a lot, right? We're dealing with people who've been good savers, they've been wise with their money. Say, if this happens, I will just pay for it. Which, I mean, I guess that's your only option if it does happen, because if you're not going to do the planning, of course you're going to pay for it in that situation. But what I want to say to those people is, when I have people who've actually been caregivers of their parents, is typically the situation. Never once have I had one of those clients who've actually been involved in the caregiving say, I'll just pay for this when this happens, right? They're the ones wanting to do the planning because they know what that looks like. And typically what happens is, when the time comes, when you get sick, you are not going to be willing to spend that money for the care because it's going to be expensive. And you have the money you saved up because you just don't spend it unwisely. And you view this as unwisely at the time, right? Because there's a lot of denial that goes into say, I can still do that. I don't need help doing that. When in reality, you do. So again, who ends up bearing that burden is your family. They step up. They're taking care of you because you don't want to pay that caregiver. The insurance policy is a way to fund that caregiving. So again, removing that burden from your kids. So again, I am passionate about this. I've lived it. I've seen it every day with our clients. I think it's really important to plan for. And of all the stuff we do, I think this is the most impactful thing that we do with our clients when we're planning for this.
Okay, so over here on the traditional, you've got a reimbursement benefit. Over here on the hybrid life long-term care, you got an indemnity benefit. So what's the difference? Say you're 75 years old and your policy pays $78.29 a month, $7,800 a month, almost $100,000 a year that you got available to you for your care. On the reimbursement, you have to spend that money in order to get it. So if you got home health care coming in and you're spending $4,000 a month, $1,000 a week, and you're just spending $4,000 a month, you get $4,000 a month as opposed to the $7,800. Under the indemnity benefit, you are in the same situation. You're spending $4,000 a month, but you get $78 a month because the insurance company just sends you the check. You spend the money as you want. And I want to point out something back to what Tom said, is under either policy, these benefits are coming out to you tax-free. And that's what a lot of people say, oh, I'll just pay for this myself. They don't realize is it gets a little more complicated because they got to pay for it out of after-tax money. With the insurance, that benefit comes to you tax-free. So going on, I want to tell you the rates on this can increase. I already told you that. They can never increase on this. Once it's set from the beginning, you pay the money, they can't increase it. The benefits are tax-free. This is what some will call it use it or lose it, meaning that the only benefit you're going to get out of this is the reimbursement for long-term care. Well, that's what it was set up for. That doesn't make it bad. It's just, I put it up there because you're going to hear that somewhere, is this money, a lot of people, what stops them from buying this, they say, well, I'm going to, my mother had this, and she paid for it for 20 years and she never used it, and we never got anything back out of it. Well, that's kind of how insurance works. Under this one, there's a death benefit. So that's the difference, and that's also why this is less expensive than this. And then you've got a discount, as I mentioned earlier, for couples. So if a 65-year-old couple, each are 65, it's going to be less expensive if they come together on a combined policy. Couple other benefits on this thing is the benefits are tax-free, there's multiple premium options. So you can 10 pay this, or you can pay to 100, or you can pay it all up. We talked about the death benefit, and there's a discount for couples. So Tom, just in comparing these two policies, I want to bring you back on, and I want you to share some thoughts.
Yeah, I mean, I think neither policy is bad. They're both options. Sometimes what drives the decision, like what we're recommending, can be an underwriting component, right? Both policies, you have to get qualified through an underwriting. Historically, they've been pretty strict on who they take. The left, the traditional long term care, more so than the hybrid policies. So it could be what we're recommending is not necessarily which policy design you like better, it's which one you can actually qualify for. So that's a piece of it there. We have other options that aren't on the board here that are less restrictive from underwriting standpoint. So again, we that can sometimes drive the decision there. It's just what you can get. But ultimately, whether it's one of these, whether it's one of the other ones we offer, I think this is important planning for you to take seriously and look at it as part of that larger plan is okay, this is one of the bigger risks that you face in retirement. It's an unknown risk, right? We don't know if you're going to need it, but if it happens, this would be the biggest thing that could potentially upend your whole retirement plan. And especially if you're married, thinking about what happens to the surviving spouse. So we think it's important to plan for. Again, neither option is bad or good. They're just tools, and the tool that through the planning process we'll figure out which one makes the most sense for you specifically.
Okay, so how does long-term care and long-term care insurance fit into a comprehensive financial plan? I mean, frankly, we've set up our business so that most people coming into us are hiring us to do a comprehensive financial plan over all 7 of these worries. And throughout that process, we're able to, first of all, learn your priorities for long-term care, or learn whether you, because some people tell us, I ain't talking about it. And so we do a plan around the other 6 worries, but then we got to figure out how to pay for it if it does happen to them, and at least prepare for that in the financial plan. But, we package long-term care. So we're going to give you our advice. If you hire us to do a financial plan, we're going to give you our advice over which one of these, or perhaps some others, you ought to think about qualifying for. So the whole video today has been around one of the 7 worries is long-term care. I will tell you with Social Security, this is one of the questions. Well, won't I still have my Social Security check if I'm in a nursing home? Well, yes, sure you will. But you probably won't be in a nursing home. You'll be in an assisted living. And sure, that'll be coming in. And that's perhaps why you can buy just $6,000 a month is the $6,000 a month plus your Social Security check is going to give you enough money to pay the total bill in the place. I mean, we haven't really talked about Medicare, but Medicare pays very little for long-term care, especially custodial long-term care. IRA 401k, a lot of folks buy a hybrid life long-term care policy, and they buy it with a chunk of IRA money. So we have a different company than we're showing here that allows you to take a hunk of your IRA money and transfer it custodian to custodian to an IRA at the insurance company, and they will slowly pay off one of these hybrid life long-term care policies. We even do it on a couple. So that's an option to buy this, is using your IRA. We haven't really talked much about income other than late in retirement is very difficult to have an explosion of need, where your income need goes from $8,000 a month to 15 grand a month, like overnight, because of the long-term care. It really can disrupt an income plan. Estate planning, I mean, that's where the hybrid life long-term care insurance, where you put a large chunk of money into this thing. If it's not all used up for long-term care, it's going to pass on to your children. And then taxes, we've talked about a little bit. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.